Our next guest says we're only about halfway through this sell-off. Let's bring in Morgan Stanley's chief U.S. equity strategist, Mike Wilson. He joins us on the fast line. Mike, great to speak with you.
Hey, Melissa, how are you?
So halfway brings us to down 10% or so?
Yeah, look, I mean, you know, the panel did a great job of kind of laying out all the concerns, things that people are aware of. I give the best award to Karen for the Halloween visual on the blood on the streets. And also, I agree with her completely at the end there, talking about, look, you know, you have to have a framework about how you're investing and not get kind of pulled around by all these different events that we know are kind of in front of us. And we got to deal with that. But if I'm buying good companies at the right price, I have confidence in over the next 12 months. Well, then I should see through that, and it should work out for me. It's the same. We think about the market the same way. So at 3,500, we're just kind of full on valuation. Okay, that's 21 times. You know, the forward numbers of 160 is where we are today, and we think kind of a fair value is closer to 20 times, which is 3,200, 3,250, something like that. And in an overshoot, you could go below that. So the risk reward as you're getting up around 3,500 just wasn't that good. That's why we called for a 10% correction just to go back to the end of that range. We've had a range of 3,100 to 3,550 since the end of August, and it's kind of ping pong back and forth. That's the framework, and so we want to add risk. If you think about it in market terms, you want to add risk towards the low end of that range, and you want to fade it towards the upper end of that range, at least until some of these things are, some of these concerns are at least, have come and gone. And I think, Guy talked about the VIX. I mean, this is how a big part of our framework is. When the VIX is higher, your equity risk premium has to be higher too. And so at 32, the equity risk premium is too low, right? So the multiple, I would argue, is too high. And that's really the framework, and we're just trying to be disciplined around that. So you have about another 5%, maybe 6-7% if it gets really bad. So call it 3,100 on the bottom end.
So how does that trading range framework change, Mike, when we have clarity on the elections? Let's assume that's in 9 days or so.
Yeah. So the VIX will come down, in theory, right? So it'll become less volatile. We'll have more clarity around who's in control, what the fiscal package might look like, what the timing of that might be. And by the way, let's not forget about the virus, which you all mentioned, the second wave. That's also weighing on volatility right now because we don't know exactly how that's going to play out. I'm optimistic that ultimately we'll get through this, but we got to go through that period. So, but as volatility comes down, as these events come and go, then the equity risk premium can come down, which is the same thing as saying the multiple can go back up.
Hey, Mike, it's Tim. Thanks for joining us. So below the surface of the market, obviously, we have subsectors, some that have been outperforming even during this period of sideways since mid-July. What do you like here? And do you think we can continue to get this rebound in some of these industrial names, some of these transport names that have been red hot? Or do you think higher rates could raise the tailwind, I should say, more tailwind behind the banks? Talk to us about how you're playing it below the headline market.
Yeah, I mean, beyond the simple trading range, which is, kind of the game we have to play, or, as we talk about as strategists, the more interesting story is beneath the surface. There is a really big bifurcation between what I would call overvalued stocks and undervalued stocks, depending on what your outlook is. So our outlook is pretty constructive for next year. We think the economy could be pretty hot, red hot in terms of growth. Obviously, easy comparison year. We could get more fiscal. Likely we'll get more fiscal once the new administration or the existing administration is inaugurated again. And as that happens, what you want to be focused on are companies that are going to deliver outsized earnings relative to expectations. Okay, so there's a couple things to think about. You mentioned a couple areas, in the industrial space, the material space, we like a lot. Financials, we think rates are going to move up once you get past these risk events in the near term. It'll drive financials. Some of the smaller mid-cap companies, which we think are underappreciated. And basically, it's a reopening theme, right? As you continue to reopen the economy, a lot of these parts of the market that has not been able to fully operate are going to see tremendous operating leverage. And I'll just finish up by saying, the third quarter earnings season so far, what we're seeing is that the revisions are flattening out, meaning we're seeing companies beat, but the out-year revisions are not as robust as they were in the second quarter, which makes sense as you get into the recovery. What we're looking for are stocks where those revisions are going to really surprise on the upside, and it may surprise you where those are. It probably isn't going to be the companies that have been benefiting from the lockdown this year. Those companies are going to have smaller revisions as the comparisons get tougher. It's going to be more of the reopening type stories.
Mike, it's Karen. Thanks for being on. How important or not is this quarter, like really this week is actually the bulk of it, for your model?
It's very important because we want to try and confirm, Karen, is where is the operating leverage already showing up? One of our themes for this year is that because the unemployment rate shot up so fast, right, operating costs have come down tremendously, and then the government has helped out with fiscal stimulus. So what we're seeing is the companies that are operating are seeing huge increases in margins and profitability. It may be surprising, but based on the third quarter estimates where we see them today, the median stock in the S&P 500 will actually have higher operating margins in the third quarter than they did a year ago. Pretty remarkable, right, in terms of the efficiency there. So that's what we're really focused on, is we're trying to find the companies where the margin upside is surprising, where we think that could continue into next year. And once again, it comes back to these sort of reopening stories. Some of the existing growth stocks too, and some of the current winners, where they've got great efficiency. So that's kind of the formula. That's what we're really looking for in the third quarter earnings season.
Mike, always great to speak with you. Thank you.
Thanks for having me.
Mike Wilson, Morgan Stanley. Guy, I think that's an important point that Mike was bringing up just now about operating margin. We have to be careful, though, that these would be sustainable operating margins. Some companies got boosts because they weren't spending as much, just because of the times that we're in.
It's so, I got to tell you, to me, it's so fascinating. Margins are increasing if you look around, across the board. And that's very good for companies, but it speaks to a much different problem, something that Dan's talked about. Companies have learned how to do more with less, and those operating margins, by definition, go higher. But you have to wonder, what does that augur for the broader economy in terms of the job market going forward here in the United States? I'm not smart enough to answer that question, but I think it's great on one hand. I think it really paints a sort of a dire picture on the other hand. That's just my 2 cents.
Yeah, Dan, last word?
Yeah, I just say that issue of structural unemployment going forward, high unemployment, is going to be here to stay for the time being. And I just, again, worry about the pull forward. We're going to see it in a lot of consumer-facing companies, the pull forward in demand and what that means for demand going forward for the next few quarters. So I'm not particularly optimistic about that. We're sitting on an S&P 500 that's up 5% and a NASDAQ that's up 26%. That's on a year where earnings were down, 30%. Last year in 2019, the S&P was up almost 30%, and earnings growth were flat. So what are we willing to pay for these earnings that have basically been subsidized by the government? I'm not certain that we are going to get the sort of returns that we expect or would like to expect on the sort of economic recovery that a lot of optimists are hoping for over the next couple of years.
Shepard Smith here. Thanks for watching CNBC on YouTube.